Welcome to A1 POA, your guide to mastering accounting concepts. For today, we will be covering this topic, Corrections of Errors, Part 2. Beforehand, let us have a quick recap on what we cover under Part 1. For Part 1, we talk about the trial balance. In specific, we talk about the errors that are not reviewed by the TB. We identify and thereafter we classify accordingly. We also learn how to correct this error that involve the wrong amount. Essentially, for Part 2, we are going to dive in further. So let us now take a look at the learning objective of Part 2. For Part 2, first and foremost, to be able to correct the errors involving the wrong account, and thereafter to identify which account title is wrongly recorded and the correct account title to be used. To have the ability to correct account titles error by reversing and re-recording the entry. In the next LO5, we want to understand the effect of the errors on the profit itself, right? Under the statement of financial position, we want to understand the effects of the error on the profit, whether the profit will be understated or overstated. To have the ability to understand how the errors in sales, the sales return, the cost of sales, income, expenses, overstate or understate profit. We have a summary table whereby we use it to articulate further, to give you a good reference points to be able to determine quickly on the spot what would be the determinations of the profit effect as a result of the error. But having said so, the table is to have a quick reference for you, but we truly need to understand the mechanism and the logic behind. Finally, in the last LO6, we want to be able to prepare a statement to show an adjusted profit. So basically, it is like a pro forma statement to be able to show the figures before and the after, right? And therefore, to be able to understand the pro forma, to adjust the profit, and to have the ability to differentiate between errors that increase profit and those that decrease profit. And all this, we can once again have a quick reference point from the table, and thereafter we will be able to apply the correction accordingly. Adjust profit for error discovered after preparing the finance account. So let us now dive in. In this slide, LO4, correcting errors involving the wrong account. Earlier in Part 1, we learned how to correct errors involving the wrong amount. Now is the wrong account. Identify errors involving wrong account. Identify which account is wrongly recorded. So exactly what we need to do, we need to identify which account title is wrongly recorded and the correct account title to be used. So over here, you can see that all in all, there is two actions that we need to close the loop as far as rectifications of this error is concerned. Firstly, to identify which account title is wrongly recorded. Only when you have the wrong account that you identified, then you will be able to correct it with the correct account title. So that will be number 2. So once again, this occurs when the wrong account is used, but the amount is correct. So wrong account is used, but the amount is correct. So let us now dive in and look at this specific example over here. In this example, it is stated that the motor vehicle repair of $150 were debited to motor vehicle instead of repair expenses. Amount is correct. You can see that the amount is correct. So amount is correct. But debited to motor vehicle instead of debiting to repair expenses. Let us now look at the analysis. We all understand that motor vehicle, it is a fixed asset classified under your statement of financial position. Statement of financial position. Whereas for repair expenses, it is an expenses, operating expenses, classified under your statement of financial performance. So since motor vehicle, which is the wrong account, have been debited, we need to do a corrections. In order to do a corrections, we will need to pass this entry whereby we do a reclassification. So when we do a reclassification, the narration is being reclassification of the wrong account. So what we will do is we will debit what and we will credit what. Since motor vehicle is wrongly debited, we will want to credit the motor vehicle. Credit motor vehicle. The values that we mentioned earlier is 150. And of course, the correct account to be debited will be your repair expenses. Right? $150. A quick recap. Repair expenses is operating expenses under the statement of financial performance. And whereas for motor vehicle, it is typically classified as a current asset under your statement of financial position. And because motor vehicle on start was debited, this account was used wrongly, and therefore we need to do a reclassification because the correct accounts to be debited will be repair expenses. Yep. With that, this sum up the correcting entry. Once again, debit repair expenses and credit motor vehicle amounting to 150. So we remove the wrong debit and record the correct one. Yep. With that, let us now go to the next one. The next one, as I mentioned earlier on, this provides a very good snapshot of the effect. So let us now orientate ourselves as far as this table is concerned, right? All in all, there's 1, 2, 3, 4, 5, 6 columns, right? We have 1 column, 2, 3, 4, 5, 6 column. So column 1 over here, column 1, we have in total 3 accounts. We have 3 accounts that fall under statement of financial performance, right? So we have these 3 accounts that fall under financial performance, statement of financial performance. Yep. So for these three accounts, there is a situation of overstating the profit B, whether it is gross profit or net profit. There's also vice versa, the flip side scenario of it, whereby the gross profit or the net profit is understated. So once we are able to understand either one of the scenario, right, be it whether overstated or understated, we will definitely be able to understand why another scenario occur. Yep. So let us now run through a quick one. We are just going to run through the factual data in terms of this table. After that, we will zoom in into the specific diagram to help you to have a better appreciation. So let us start with column 1. Under column 1, once again, there's three accounts. We have 1, 2, 3. So for the first one, you talk about sales revenue. There is a correction whereby we debit sales revenue. Now, we debit sales revenue is because on start over here, this particular account is overstated. So too much of a credit, and therefore we need to reduce. In order to reduce, we need to debit. So before we do any correction, right, it is definitely understandable that the gross profit is overstated. Likewise, the net profit over here is overstated as well. So after you do a correction, right, automatically you'll be able to see that the gross profit will drop, and then of course the net profit in this instance will drop as well, right? So once you're able to understand that, right, you will be able to have a much more better appreciation in terms of the next line item that talk about the opposite. In this instance over here, we have sales revenue. The correction is we credit, and the reason why we want to credit is because gross profit is understated, and of course net profit is understated as well. So as a result of that, right, after we do the correction, the effect of the gross profit will of course go up. Likewise for the net profit, it will go up as well. Yep. So bear in mind, if you can, you take a photo of this. So later when I'm going to go through the diagram itself, when you cross-reference to the photo that you took, right, you will have a much more better learning outcome. We have covered the first account. Let us now talk about the second account, which is the sales return. Now, we all know that the sales return is the opposite of sales, right? When you deliver to your customer goods and services, your customer therefore decided to return you the goods or rejections of the services that you provided because there's a dispute in terms of the understanding. Probably you deliver to him a goods that is made of a circle sheet, but in his record, he want a rectangular sheet kind of goods. So therefore, he return back to you. So let us take a look. What do we mean by when we do a corrections by doing a debiting on the sales return? So when we do that, we know that sales return, the nature of the sales return, we know that the nature will be of a debit nature, right? So when we do a debit of the sales return, essentially what we are saying is that sales return is understated. And when sales return are understated, automatically that would imply that your gross profit and net profit are overstated. So, and therefore you will want to do a top up of the shortfall amount in the sales return account. And when you do that, of course, automatically your GP and your NP, which is your gross profit and net profit respectively, will reduce. So once we have a clear understanding of this, right, the next line items, which is the crediting of the sales return in terms of the correction, everything will fall in place. Let us now go through sales return. When we do a credit of the sales return, essentially we are of the opinion that the sales return are overstated. So we know that the nature is of a debit nature. When we credit, right, we actually reduce the sales return. And the effect of the error on start is there is an understating of the gross profit. So when we do a credit of the sales return, this is where you will realize that as a whole, your GP and your MP, after the correction, it will go up respectively. Yep. You will realize that your cost of sales, this one, and this one, when you do a correction in terms of the crediting, right, to rectify the error, you will realize that the effect on the error on start are the same. You have understating for the GP, you have understating for the NP. Likewise, over here, you have understating. The last line items, cost of sales, the corrections will be a debit. So this is the flip side of what we went through earlier on, which is cost of sales, credit. So in this instance, of course, the opposite scenario will happen. The error effect on the GP and the MP on start will be overstated, and because of that, you will need to do a debit of the cost of sales. And when you did that right, you will realize that your GP and your MP, the effect will therefore reduce. So you can see that over here, this one and this one, the scenario is exactly the same. Overstated as far as the GP MP is concerned, and after the correction, the GP and the MP will drop accordingly. Yep. So once you have a hang of it, right, by looking at this table, beside the benefit of this table giving you the quick snapshot in terms of the reference point, on the other hand, you'll be able to think through faster in terms of your thought process. We are now going to go to a quick recap using this useful table over here. So over here, you can see this is a overall summary in terms of the sales revenue, sales return, and cost of sales. So now let us run through. I'm sure after looking at that in-depth analysis, right, when we cross-reference back to this summary, everything will make sense. Everything, the dotted line will be able to connect together. So the corrections item over here, on start, we look at the effect, right? We want to debit sales revenue, debit sales return, debit cost of sales. And that's because the effect of the error on the gross profit and the profit for the year, which is the net profit, are overstated. And after we did the correction, you will realize that your GP and your MP, it drops. So when you have that understanding, right, the flip side of it is that when you do a crediting for these three line items, the on-start effect of the error will be understated. And after you did the correction, the GP and the MP will increase. Now, with that, let us now look at the other two line items, which are income and expenses. Other income and other expenses, right? So the keyword here is other. So you will realize that other income, essentially, it is referring to a similar nature, just like sales revenue. And other expenses, the similar nature will be your cost of sales. And the very fact that there is no effect on the gross profit is because we learned that other income and other expenses, typically they are presented in terms of the presentation of the financial statement, they are presented after your gross profit, right? So there is no effect on the gross profit unless you present it wrongly, whereby you lump together with the other component under your gross profit component. So therefore, there's no effect, but the logic, the thinking process is exactly the same as we mentioned. Other income, it is similar like sales revenue. And when you do a debit in terms of the correction, you basically know that it is overstated, and therefore when you do the correction in terms of debiting the income, the effect will be, of course, a decrease over here. For other expenses, very similar to cost of sales, right? It's just that there is no effect on the gross profit. For other expenses, when we do a debit, that is because net profit for the year is overstated, and therefore after the correction, after you debit the account other expenses, the net profit for the year will decrease. So once you have this in mind, right, when you look at the last line items, which is doing the corrections of crediting other income and other expenses, the vice versa outcome will be the case. So in this instance over here, when you credit other income and other expenses, that is because profit for the year are understated. And the effect of the corrections will be your profit for the year will be increased as a result of you crediting your other income and expenses. So now let us come back to this main slide. As per the earlier illustration, you can see that we have covered other income and other expenses. We also touch base on purchases, of which purchases form the main bulk of the cost of sales. And in this instance over here, we also mention purchase return, right? Purchase return, it is just you returning the goods that you bought from your supplier, but due to whatever reason, the dimension issue, the item is not in accordance with your required specification based on your expectation, you return back to your supplier. So with that, let us now reiterate once again what we have run through in the illustration. But of course now in this context, by zooming into this format, this particular table format. So for purchases or slash purchase return, when we do a debit, essentially what does that mean? That implies that the gross profit is understated for the GP and also likewise for the net profit. So after your adjustment in terms of debiting, right, you will realize that your GP will go up and your NP of course will go up. So the flip side, of course, when you do a adjustment in terms of crediting the purchases slash purchase return, you will realize that your GP on start is overstated and your NP are overstated, net profit is overstated, and after you did the correction, it will of course drop. Other income, right? Other income, we talk about debit, right? When you do an adjustment of a debit, that's because your net profit is overstated, and after your adjustment, of course, it will drop. And vice versa, you will realize that this particular effect, it is similar to these line items over here, other expenses, right? Because when you do a corrections by doing a debiting of your other expenses, that is because your profit, your net profit in this instance is overstated. And after you did the corrections by debiting your expenses, you topping up your expenses in a sense. And this is where you realize that your net profit, of course, it will drop. So with that in mind, right, this itself gives you an overall, once again, a snapshot of what you can refer to in terms of a quick reference point. But more importantly is that your ability to be able to articulate, understand the mechanism behind, and for you, subsequently, when you are doing the pro forma statement in terms of the effect of correcting the profit before and after, you will be able to grab it faster and coming out with the answer faster. Let us now go to the next slide. In this particular slide, we are still focusing on the effects of error in profit. The accounts that we are looking at are as follows: depreciation, provisions for doubtful debts or bad debts, and last but not least, accrued expenses or prepayment. For the first one, depreciation. just take it that depreciation is one of the other expenses. And if you refer back to the earlier slide under the other expenses over here, we say that if we want to do a correction by debiting expenses, the original error of overstating of the profit now will reduce. Same thing, if you look at depreciation over here, if we were to do a debiting, that implies that the initial overstated of profit will now be reduced. So if you look at the effect is the same. Same thing, if we are looking at the vice versa adjustment, in this instance, instead of debit, we need to credit as part of correction. That is really primarily for the purpose of the fact that on start, the profit is understated. And after we do the adjustment by doing a crediting of the account depreciation, the effect of the profit now will go up. Relating back to the earlier slide, you can see over here, if we do a credit, the original error, which is an understatement, will then increase over here. Next, we look at provision for doubtful debts, which is the bad debts in this instance over here. So bad debts itself, it is just like an expenses, right? When customer avoid paying you due to whatever reason, right? You try to contact them, you couldn't reach them, you try to email them, call them, they are not able to be contacted. After a certain period of time, you establish with adequate evidence that it is not possible to be able to get back the amount that they owe you. You therefore decided to do a provision of doubtful debt, and eventually you write off the account receivable as a bad debt. And when that happens, this is where in the books of account, you will be able to see under your statement of financial performance, you have an expenses called bad debts, which we have covered in the previous chapter. So under this kind of circumstances, right, what if the bad debts are overstated? When it is overstated, we will then need to do a credit as part of the correction. And when we did that, the initial error of understating of the profit now will increase after your adjustment. Look at it as just yet another expenses. You can see over here, right? When you do a credit of expenses, your provisions for doubtful debt, same thing, just like a bad debt itself or doubtful debts, you credit because it is understated. And therefore, after the adjustment, now the profit increase. Next, we talk about the flip side, the vice versa adjustment. In this instance, instead of credit, we debit. So when we debit over here, that is because the error effect on the profit is overstated. And as a result of our adjustment, the effect of the profit now reduced over here. Same thing, you can see over here, if we do a debit of the expenses, that is because on start the error have a overstated profit, and now we reduce it. Yep. With that, now it comes to accrued expenses. Now accrued expenses, in our previous chapter, we talked about the reason why we want to accrue a cost. The reason is because you know that a cost whereby the probability of such existence is high, even though the supplier didn't provide you the invoice. Maybe the finance department of the supplier went on leave. So you do an accrual, right? So when you do accrual, basically you are making sure that you have adequate enough of expenses to be reflected in the statement of financial performance, so that there will be a reasonable matching principle to be in place. So in this instance over here, we will just emphasize again that the accrued expenses, when you ensure you are basically treating it as an expenses whereby it has to be adequately being reflected in the financial statement. So therefore, when you credit, it is as good as saying that the expenses is overstated, right? The expenses is overstated, therefore you credit. And when you do a crediting, once again, you can see that this one and this one, intuitively, it is about the same situation. The error effect on the profit is understated. And because of your adjustment, this is where you see that the effect of the profit go up. So same thing. The flip side of it is when you find that there is a need to do a correction by debiting the expenses. Probably the amount of accrued expenses that you cater for earlier on is not sufficient, right? So as a result of that, there is an overstatement. And when you see that there's an overstatement, you look at it, it is exactly the same as this one over here, right? Exactly the same. Yep. So you debit, and the error effect of on start the initial overstated profit now will reduce. Same situation. We talk about accrued expenses. Now we talk about prepayment, right? Prepayment. We know that for prepayment over here, prepayment is when you pay in advance. For example, your business insurance for the year 2026. So typically that's the case, right? We pay insurance in advance, and every month we enjoy the insurance coverage. And when we enjoy the insurance coverage, this is where we will reclass the amount from the prepayment to become actual paid expenses to match in accordance with the period that we enjoy the insurance coverage. So in this instance over here, for this particular table, when we say that there is a over prepayment, we have to debit. So for the prepayment, let me illustrate over here. We have two columns. The first column is the wrong column. The second column is the correct column, right? So under the wrong column, what happened is that the accountant debited prepayment 150. Rightfully, the prepayment should be just $100. And under the wrong column, expenses $50. And under the right column, expenses is $100. Now in both columns, the total value is $200. But the thing is that under the wrong column over here, profit is overstated because the correct expenses to be debited is $100 instead of $50. So as a result of that, when we do the adjustment, we will debit the expenses to top up the differences of the $50. Right? The flip side of it is, of course, we will credit prepayment of $50. So when we do that, right, what happened is that you can see that the expenses over here, $50, now we top up to $100 by doing a top up of $50 over here. And for prepayment over here, you can see that we reduce 150 to 100 here by doing a crediting of the prepayment of $50. So I hope that that gives you a quick snapshot in terms of the adjustment behind this error. So with that in mind, let us now go back to the slide. So once again, you can see over here, the illustration that I have earlier on, whereby we say that we debit the over prepaid amount of the $50, and therefore the error effect of the profit, which is overstated now, would have been reduced by $50. So vice versa, the flip side of it is, if the expenses is under prepayment, this is where we do a credit, and when we do that, right, the initial error of understated profit will now increase, right? So with that in mind, now let us go into the next slide. Let us now look at this slide. Memory, by and large, there's three accounts that we need to focus on. The first one will be the inventory, of which there's closing and there's opening as well. Next, we will talk about drawings. Last but not least, capital. And with that, let me recap first and foremost on inventory. So under the statement of financial performance, we have sales. After that, we have less cost of goods sold. For example, a ballpark values is 30K, cost of goods sold 18K. This is where your GP, your gross profit, you would have 12K. Thereafter, you less off your operating expenses, perhaps 7K, you will have a balances of 5K, and this is net profit. So as far as the cost of goods sold is concerned, right, formula, we have the opening balance, we have the additional during the year, whether you purchase or you make. After that, you have your cost of goods available for sales, right? And then you less your closing balances, your stock. And then you will be able to derive at 18K. So let us work back retrospectively. For example, your closing stock, perhaps your closing stock is 6K. So therefore, your cost of goods available for sales, when you work back, right, you have to use 18K plus 6K. And then this is where you will need to have 24K over here. And when you work back further, right, maybe purchases during the year, perhaps 8K. And therefore, your opening balance will be 16K. So let us just run through a quick one to make sure that we are correct. So 16 plus 8 give you 24. 24, you less off 6, that will give you 18. Yep. So when we say that your opening inventory is overstated, right? So perhaps instead of 16K, it is 18K. So you can see that the downstream impact is that with all things being equal, here you will have 26K. Less closing balance, assuming nothing changed, right? This is where you will have 20K. And over here, it will be 20K. When you have 20K, your GP for sure, it will drop by 2K, and therefore it will be 10K. Likewise, 10K, you less off 7K, you have 3K here. Yep. So the second line items pertaining to the table that we shared earlier on, that one is talking about understated of opening inventory. So that one is just a vice versa effect. But more importantly is that now we need to look at the closing stock as part of reinforcing the learning on this mechanism over here. So let me use another color. I will use green color. Closing stock. Closing stock over here, assuming closing stock is overstated. So instead of 6K, right, let's say it is now 7K. If it is 7K, right, your 24K minus 7K, that will give you how much? That will give you 17K here. Yep. And because of that, you can see that your closing balances attribute to a reduction of the cost of goods sold from 18K to 17K. And therefore here it became 17K. So your 30K, you less off your 17K, that will give you 13K. Your 13K less off operating expenses, assuming that there is no changes, that will give you 6K. 6K over here. So if your inventory is overstated, right, you will realize that your error effect on the GP and your MP over here, it will be overstated, as you can see over here. 13K versus 12K for the GP and 6K versus 5K for the MP. Yep. So hope that give you an overall snapshot in terms of the effect as a result of opening inventory as well as closing inventory, be it whether it is overstated or understated. The specific illustration that I shared earlier on pertaining to the opening balances and the closing balances are all on the overstating side. The understating, all the figures will be the opposite direction. You can use this framework to try it yourself. With that, let us now come back to this table. Once again, as I mentioned, if your opening inventory is overstated, your GP and MP will be understated correctly. And when you do a correction, the effect of the MP and GP respectively will go up. Likewise, if it is understated, the flip side effect will happen accordingly. And we also talk about the closing inventory, whereby we illustrate earlier, if the inventory is overstated over here, this is where the effect on the GP and MP will be as such, overstated, and when you do the correction, the profit will reduce. And last but not least, we talk about the flip side of it, right? If closing inventory is understated, of course, your GP and your MP will be understated respectively. And when you do the correction, of course, the effect is that the GP and the profit, the MP, will go up. With that, let us now look at drawings. Once again, when we look at drawing, let me go back with the earlier illustrations, and I will just clear away this and focusing on the two remaining account. Drawing and capital. Drawing. Let us now talk about drawing. Drawing, as we learned in the previous topic, drawing is when you have the owner's equity, perhaps 100k, of which the equity comprised of on start the capital of 10k, your profit, accumulated profit over time, right? Over the years, maybe for the past 3 years, accumulated is 40k. And then you have a less drawing. Your this drawing, perhaps it is 20k. $10k plus 40k, 50k, 50k minus 20k, that will give you 30k. So the equity will be 30k instead. 30k rather than 100k based on the figures that I plug in. So over here it says that the drawings record as expenses. So instead of recording it as a drawing, right, what happened is that the wrong entry, perhaps the accountant debit expenses and then credit bank 20k. We know that the correct entry is with debit drawing, of which drawing is a contra account inside the owner's equity presentation. So you can see it is very clear cut that when this happened, your expenses is overstated, and when your expenses is overstated, right, profit is understated. Yep, you can go back and refer back to the slide here. Drawing record as expenses. So when your drawing is recorded as expenses instead, and when you do a correction of crediting it, this is where you will lead to a correction whereby the profit from understated, it will now be corrected over here. So let us now take a look one more time. Back to here. Over here, when we credit the expenses, and then after we debit back the drawing, we are doing a corrections whereby this one and this one will be contra of, and we will be able to state correctly the drawing as part of the presentation under the owner's equity in your statement of financial position. So with that, we will come to the last one, which is capital, right? Over here, it says that capital is recorded as income, and therefore there is a need to rectify by doing a debiting. And thereafter, when we do a debiting over here, the net profit, the on-start error of overstating here will be rectified accordingly here. Now, please bear in mind that for the drawing and capital, right, the GP is not applicable at all, right? Because it has nothing to do with the profitability of the product itself at the GP level. Yep, so this is not applicable over here. So let us now take a look at capital in specific. Capital recorded as income. So under normal circumstances, right, the correct entry when the sole proprietor, he inject fund into the business, you debit bank, for example, 10K, and you credit your capital 10K. But now the wrong entry is you credit income instead. Now this is under the statement of financial position. And this one is under your statement of financial performance. Therefore, when you did this, you will realize that your profit is overstated, right? And because of that, your adjustment, it will be debit income and credit capital. So over here, we have to debit income 10K. And it is because of that, when you refer back, you debit your income. Debit income as part of the correction, and you credit capital to ensure that the capital is being reflected in the owner's equity under the statement of financial position. So when you do that, the overstated net profit in this instance over here, it will reduce as a result of this adjustment. Debit income. With that, let us now go to the next slide. Understanding the directions of the effect helps when preparing the adjusted profit. And we need practice. If we don't practice consistently and frequently enough, we will not be able to have a good grip of the flow of the mechanism in specific for part 2 corrections of error. So now let us go to LO6. LO6, prepare a statement that shows the adjusted profit. Remember earlier on I mentioned about pro forma statement whereby we show the before and after figure after we do the necessary adjustment. This slide personally, to me, I like this particular presentations a lot because it can really help to explain and articulate the mechanism behind the thought process in terms of the adjustment. So let's run through a quick one. Over here, adjust profit for errors discovered after preparing the financial statement, assuming that you have closed the books of account and you realize that there's error. So over here, statement of adjusted profit. You have on start, you have this profit for the year before correction, meaning that this is the wrong figure or the wrong value, right? And therefore, for you to do the adjustment, you add and you less. So what are the things that you add and what are the things that you less? Let us now take a look. You add item that increase profit, right? You add item that increase profit, meaning that earlier on profit is understated and therefore you increase the profit. For example, omitted revenue, right? You didn't record the transactions, you only properly record the cash sales, but you forget about the credit sales. Overstated expenses. Yep, overstated expenses. And therefore, these are the things that you will need to bear in mind to make sure that you correct accordingly so that the profit will be increased. Next, you less items that decrease the profit. You less items that decrease the profit. For example, omitted expenses over here and overstated revenue. So in this instance over here, profit is overstated. Maybe some of the expenses you forget to record and therefore expenses are not adequately being reflected. The expenses are too little and therefore the profit become overstated. Another thing is you have overstated of revenue here and therefore you need to adjust the revenue to bring it down, and therefore after you make this adjustment you'll be able to come to this overall adjusted net profit over here. Yep. So this is a very structured flow in terms of giving you what need to be added, what need to be less, so that you'll be able to derive at the correct adjusted net profit. Let us now run through with a specific example. So in this instance over here, profit before correction $50K Sing dollar. So we will add and we will less. For the add portion, we have item that increase profit. First and foremost, we have omitted revenue, i.e. sales not recorded, $2K. After that, we have overstated expenses. Example, rent paid, recorded twice, 1.5K. So this all in all will be 3.5K. Next, we have the adjustment on the less portion, whereby we say that these are the items that decrease profit. For example, we have omitted expenses such as your utility bills, not recorded, $800, for example. Overstated revenue such as credit sales, over recorded. Example, 1.2K. So this effect over here will be 2K, right? So when you use 50k, you add 3.5k, and then after that you less off 2k, you will be able to derive at your correct profit. And that will be 50k add 3.5k. That will give you 53.5k, and you less off 2k over here, and you will be able to get 51.5k. This will be the correct value of the profit. With that, let us now go back to the original slide. Over here, there's this example. Reported net profit of 20,000. The corrections, omitted revenue of 1,002 to be added. Repairs recorded twice $500. So this one, you have to add back this $500 as well. Purchases understated $800. This one you have to less. So once you have these two line items whereby you add and then this one you less, you will be able to get the correct adjusted profit. Very similar to the specific example that we ran through earlier on. So let us now take a look at the correction. Profit for the year before corrections 20,000. You omitted the revenue, and when you omitted, now you need to make sure that you account for it, right? So this is where you add back the 1,002 over here. Next, you have the repair. Remember, repair, we say that overstated of repair expenses. So it's a double count, and if it is a double count, you actually double deduct or you overstated your expenses by 500, and then this is where you will need to add back because it has been deducted twice. So you add back this $500, and for the purchases on start, we say that in the example, purchases is understated by $800, and if it is understated by $800, you have to make sure that you account for these purchases, and therefore $800 to be less off as part of cost of sales, and this is where you'll be able to derive at this answer, which is 20,900. 20,900 will be the values. With that, let us now go to the next slide, which is test your knowledge. Identifying errors involving wrong accounts. Identify which account title is wrongly recorded and the correct account title to be used. Let us run through the question. A payment of $100 for insurance was correctly debited to the insurance expenses. So very straightforward, I debit insurance expenses, but mistakenly credit to the sales account. Which two accounts are required for the correcting journal entry? So over here, we can see that the keyword here is payment. So if it is payment, right, definitely bank account will be involved, right? Bank account will be involved. And we know that since crediting to the sales account is wrong, these two accounts will be involved as part of the correction. So therefore, let us run through A, B, C, and D to check and confirm. First one, insurance expenses as suspend account. No, at no circumstances as suspend account come into the picture, right? So this is not relevant. So A is not the correct answer. B, bank account, okay, bank account, yes. We have bank account here. And suspend account, no, suspend account is wrong. Because as I said, suspend account at any point of time, it is not part of this question at all, right? This question didn't mention suspend account at the first place. And therefore, B is the wrong option. C, sales account and insurance expenses. sales accounts and insurance expenses. So over here, the question already told us that insurance was correctly debited to the insurance expenses account. Therefore, this is wrong. And as a result, C is wrong. Last but not least, D, sales account and bank account. Earlier on, as part of the explanation, we mentioned that these two accounts need to be involved, which is bank account and insurance expenses. So here we have bank account, and then after that we have sales account here, right? So this must be the correct answer. Therefore, the answer is D. D is the correct answer. Next question. A payment of $50 for electricity was wrongly debited to the water expense account. So let us write down over here. So this is wrong. Debit to water expense. This is wrong. The correct entry should be debit to electricity expenses. This one should be correct. So at no circumstances it mentioned that the recording of the payment of the $50 is wrong. So we will assume that we credit to the bank of $50. Okay. So this should be the correct entry, but the question is asking us which correcting journal entry is required because water expenses was debited instead of debiting electricity expenses of $50. So number 1, the first choice, debit water expenses. Again, this is wrong because 2 wrongs doesn't equal to 1 right. If we debit water expenses, again, we are double counting this error. Electricity expenses to be credited over here. Okay, electricity expenses to be credited over here. Again, is that for this one, we are trying to ensure that the electricity expenses is recognized. So by doing a reductions of the electricity expenses by crediting it, we are making the situation not better. So this one is wrong. So A is definitely out. So now let us come to B. Debit cash at bank $50. So this one is wrong because we are talking about payment of $50, not a receipt of $50 in the cash at bank. Credit water expenses. This one is correct over here because when water expenses is accidentally being debited, we want to eliminate this by crediting water expenses. But because over here, the first portion, debit cash at bank $50 is wrong, and therefore we cannot select B to be the correct answer. And therefore, B is not the correct answer. Let us come to C. Debit electricity expenses. Yes, this one is correct. Debit electricity expenses. And we credit water expenses. So this and this, as I mentioned earlier on, credit water expenses is correct because we want to eliminate water expenses because it is overstated in the sense that it is not necessary at the first place. So C seems to be the correct answer, but let us double confirm by looking at D. D here it says that debit electricity expenses, yes, correct. Credit water expenses, yes, correct. But if you look at it carefully, right, between C and D, C is talking about $50 and D is talking about $100. And over here, we can see that on start the question already tell us that it is $50. And therefore, because of this, D will be the wrong option because of the wrong values over here. Therefore, D is wrong as well. And because of that, C is the correct answer. Next, we will understand how errors in sales return, cost of sales, income and expenses overstated or understate profit. overstate or understate profit in this instance? So the question is asking us to be able to understand how the error in all these category understate or overstate the profit with a fill in the blank question. If the sales return account, a deductions from sales, as we know, sales return is basically you sell something and customer return back the goods to you, maybe partially or fully, is understated by 500. Let us do a quick illustration. So you have sales, maybe 1,800 for example. You have sales return, right? You have sales return over here, 700. And of which the correct value is 700 plus 500, which is 1200, assuming, right? So what happened is that we know that this is understated, and we also know that as part of the presentation, right, you have sales and you need to less or sales return, so you less. So your GP in this instant over here is 1008, you minus 700, that will give you 1001. But on the other hand, if you less of the right values, you have 1008, you less off 1200, you will get 600 over here. So you can see that there is a differences whereby in this instant, under the wrong scenario, right, the GP actually is higher, right? A is higher than B. A is higher than B. And therefore, gross profit will be overstated by $500. So the answer, it has to be B. Overstated by $500. So over here, you can run through a quick one. First one, just to double confirm. A, understated. No, it is overstated, as you can see over here. A more than B. So this is wrong. C, unaffected. It cannot be, right? Because A is not equal to B. D, decrease. No, it's not going to decrease, as you can see. It actually increase. The gross profit will be increased from 600 to 1100 as a result of understating the sales return by 500. Instead of 1002, it is now 700. So therefore, the answer must be B. Answer is B. Okay. This question talk about a commission income of $800 was completely forgotten and omitted from the accounting record. So with all things being equal, right, you have expenses, let's say $500, and a commission income of $800. Assuming the $800 is being recorded, you will have a net profit of $300. But on the other hand, if this is being omitted, it's not being filled up, here you have $500 as usual. You will have a loss of $500 in this instant. So when you compare A versus B, of which B is wrong, and A is correct, you realize that B is lesser than A in terms of the value. So let us run through the option. A, gross profit is understated by 800. The term itself, right, gross profit, you know that this is not applicable because we are talking about net profit. Why we are talking about net profit? Because there's no cost of sales implication in this particular question. There's no cost of sales, there's no cost of goods sold mentioned. So A, because of the gross profit, we know that on start this is wrong, and therefore A is not the correct option. B, net profit is overstated by $800. Not the case, because you can see that B is wrong. Here, this is B. B is wrong. And B is lesser than A. So B, over here, the option says that net profit is overstated by $800. This one is definitely wrong because B is less than A. So wrong. C, net profit is understated by $800. Seems to be the case. Why? Because here B, which is under the wrong scenario whereby the commission is not being captured, is smaller than A. So net profit as a result of that is understated by 800 because if you use a deficit of 500, you need to top up by $800 in order to derive at the net profit of $300. So therefore C should be the correct answer. But let us double confirm by looking at D. D, here it says that net profit remain unchanged as it is a non-core activity. So definitely this is not the case because for sure there is changes, right? So as a result of that, because of the word here remain unchanged, this is wrong. The whole entire option is wrong. And therefore the answer, it must be C here. It must be C. These questions talk about differentiations between errors that increase profit and those that decrease profit. So refer back to the earlier slide, right? This very good formula for us to benchmark against. We have profit before correction. After that, we will need to add items that increase profit. So example, omitted revenue, overstated expenses, and we will less off omitted expenses and overstated revenue. Okay. So in this instance here, it says that once again, which error when corrected will result in an increase in the reported net profit. Omitted revenues items from the book, so you add and then therefore the net profit will increase. This seems to be the correct answer, but let us look at B, C, and D first. So A seems to be correct. That aligns with the increase in the reported net profit once being corrected. B, overstating a revenue item. If you overstate revenue items in the book, right, you correct by lessing it off from the statement of financial performance, the overall net profit will reduce, and therefore this one is wrong, right? This one is wrong. Because as I said, it will reduce, it will not increase. C, omitting an expenses item from the book is the same as C and B. Exactly the same, right? The effect is the same. Omitting an expenses from the book is here. When you omit the expenses, right, the net profit as a whole will reduce. It will not increase. So therefore, C is the wrong option. D, overstating the closing inventory figure. We all know that for inventory, closing inventory, when your closing inventory is overstated, and when you reduce it, your profit will also reduce at the same time. Yep. Based on the earlier example that we went through. And it is because of that, D is also wrong. And therefore, the correct answer must be A. So the answer is A. A is the correct answer. Yep. Last but not least, for part 2, the last question. Adjust profit for errors discovered after preparing the final account. Right? Discovered after preparing the final account. Net profit for the year before discovering any errors was $25,000. It was found that a $500 payment for advertising was entirely omitted from the record. What is the adjusted profit? So you have 25k here, right? 25k, which is the profit before correction. Now, if there is expenses of $500 that have been omitted, you have to take into account. So this is where you have to add back these omitted expenses. And therefore, you will then derive an adjusted profit of 24.5k. So therefore, the answer will be B. B is the correct answer. A is wrong because it is not 24.5. C, D likewise is wrong. So if you refer to this is actually sub-representations of the previous question whereby we apply this portion over here. We less off the omitted expenses here. So answer is B. With this in mind, we have come to the end of the MCQ practice. Let us now do an overall quick recap as far as part 2 corrections of error is concerned. In part 2, firstly, we learn how to identify errors involving the wrong account, and thereafter having the ability to be able to identify which accounts is wrongly recorded, and more importantly, the correct accounts title to be used. We also dive into correcting the accounts title error by having the knowledge to be able to reverse and to re-record the entry. Thereafter, we talk about the effects of the error in profit. So we come up with the pro forma statements before and after the changes as far as the statement of financial performance are concerned. This is where we understand how the error in the sales return, the cost of sales, the income and expenses are over or understating the profit. And we use a very useful table to be able to determine all these profit effect. And lastly, we went ahead to prepare a statement to show the adjusted profit and internalize the ability and the application, the skill set to adjust the profit by understanding the pro forma statement of the statement of financial performance, and thereafter to differentiate between errors that increase profit and those that decrease profit. And last but not least, to adjust profit for all these errors discovered after preparing the accounts. We have come to the end of part 2, corrections of errors. If you enjoy this lesson and want to dive deeper into more accounting topics, come learn with us at A1 POA. You have taken the first step by watching this video. The next one, join A1 POA to level up your knowledge from 0 to A1. Master POA with confidence. Don't forget to like, share and subscribe for more accounting tutorials. You can also reach us on WhatsApp. Details are flashed on your screen for enrollment information. This is Lawrence from A1 POA. See you in the next lesson.